Good day, everyone. It's a pleasure to be able to take part in the TMX Group's Australia Day and to share with you the opportunities Pear Tree brings to issuers with an interest in Canadian mineral projects. My name is Lisa Davis, and I'm the CEO of Pear Tree Securities. I'd like to start by telling you a little bit about Pear Tree. We are a niche financial services firm established in 2007, providing over $200 million annually in exploration and development capital alongside long-term strategic and institutional investors. We offer a platform that enables global investors to purchase equity to finance Canadian projects at attractive discounts to market prices. Over the past dozen years, Pear Tree has become the single largest source of capital for exploration financing in Canada, primarily through the TSX and TSX Venture Exchange. We've accomplished this by leveraging the Canadian flow-through share regime. Most equity for junior mining companies is raised through offerings of flow-through shares. Some of you may be familiar with this financing tool, but many non-Canadians are not, since originally only Canadians could utilize flow-through shares to make an investment in a Canadian project. The flow-through share regime plays an essential role in attracting investment for exploration companies operating in Canada. This chart breaks down the equity financing completed through the TSX and TSX Venture Exchanges for mineral exploration in Canada between flow-through share and non-flow-through share offerings. As you can see, on average, about 2/3 of equity capital raised for Canadian exploration has been raised via flow-through share offerings. For financings raising $20 million or less, that number increases to almost 80%. So, what is a flow-through share? Flow-through shares are simply common shares with tax features available only to Canadian resident share subscribers. Since exploration companies may not generate revenue for many years, the value of the tax deductions resulting from their exploration activities is very limited. The flow-through share regime permits issuers to transfer certain exploration and development expenses to the subscribers for the flow-through shares, allowing these subscribers to claim the deductions against their own taxable income. It's important to note that while the proceeds of a flow-through share offering must be used for exploration or development in Canada, the issuer of the shares need not be incorporated under the laws of a Canadian jurisdiction. Generally speaking, any company in the principal business of mining or mineral exploration can issue flow-through shares, provided the exchange on which those shares are listed has the necessary understanding of the applicable market dynamics to readily approve the offering. Those market dynamics are not conventional outside of Canadian exchanges, particularly in light of the innovative format used by Pear Tree to allow non-Canadian investors to access this market. The value of the tax benefits associated with flow-through shares affords the companies the opportunity to issue shares at a premium to their market price. Traditionally, this has meant that many investment opportunities in Canadian mineral projects were not accessible to non-Canadian investors, since the offering price for a flow-through share factors in tax benefits available only to Canadian subscribers. The type of expenses that a company may renounce in favor of flow-through share subscribers must fit within the definition of Canadian exploration expense. That is, expenses incurred for the purpose of determining the existence, location, extent, or quality of a mineral resource in Canada. Expenses incurred a little later on in the business cycle of a mining company also qualify for flow-through treatment, but the tax deduction of a flow-through share subscriber has to be amortized over time, usually 30% on a declining balance basis. These expenses are generally the costs of developing and building a mine, but do not include the costs of acquiring the resource property or any depreciable property. Now we come to the innovation introduced by Pear Tree in what have become known as charitable flow-through financings. These transactions involve 3 simple steps. First, Canadian subscribers purchase flow-through shares. As the original purchasers, they are entitled to the tax benefits associated with the shares. The subscribers for the flow-through shares then donate their shares to charity and receive a further tax credit for the value of the donated shares. Finally, the charity immediately sells the shares to a pre-identified third-party investor. Since flow-through shares are simply common equity in the hands of a subsequent purchaser, the universe of investors is significantly expanded to include any global institutional and strategic investor. And because the value of the tax benefits to a Canadian donor is great, the economics of the transaction can achieve the objectives of all parties with the sale of the common shares at a significant discount to their trading price. The sale to the end buyer in the transaction will settle immediately following the issuance of the shares to the initial subscriber, so that the end buyer is in the same position they would have been in by participating in the offering directly. Let's look at an actual example. This slide describes a recently completed transaction we arranged for Benz Mining to finance exploration work on the company's properties in the province of Quebec. In this financing, Pear Tree, on behalf of its clients, purchased units at a price of 87.5 cents per unit for gross proceeds of $13 million, a premium of about 24% to the previous closing price on the TSX Venture Exchange. Each unit consisted of 1 flow-through common share of the company and a half common share purchase warrant. The units were donated by the initial subscribers who retained the Canadian tax benefits arising from a purchase of flow-through shares, as well as for making a gift to a charity. Immediately after the donation of the securities, the charity sold the units to investors, mostly based in Australia, at 50 cents per unit, a significant discount to market. These end buyers acquired the same shares issued for $13 million for a total purchase price of approximately $7.5 million. The difference between the original subscription price and the sale price to the end buyers varies depending on a number of factors. In addition, the allocation of that delta between a premium issue price and a discounted purchase price is a matter of negotiation in each situation. A less mature company may have to offer a greater discount to the end buyers to get the deal completed, but as I mentioned earlier, Pear Tree is able to bridge the gap in that negotiation. You can see from the examples I just reviewed that whether you are looking at this through the lens of an investor or an issuer, there are significant benefits. Pear Tree's investment platform allows issuers to command higher prices for shares issued, meaning less dilution. We subsidize the cost of investment by utilizing Canadian tax deductions and credits available to initial Canadian subscribers, and we do this without any additional fees charged to issuers or investors. We arrange transactions both in the context of broader underwritten offerings working alongside brokers at no additional cost, and also directly with purchasers interested in making a strategic investment on better terms than would otherwise be available. We have arranged transactions in almost every province and territory in Canada. In 2020 alone, we will have completed close to 50 financings, mostly for issuers listed on the TSX Venture Exchange. I can't end this presentation without taking a moment to highlight the values at the core of Pear Tree's business. While we have become a key player in the ecosystem of exploration and development financing for Canadian projects, We do this through an arrangement that enables the donation of millions of dollars to worthy charitable causes, and we are extremely proud of that. The origination of Pear Tree's business in 2007 with the flow-through share donation platform was based on principles that are only now becoming a focus of investors in the mineral sector. A financing structured as a flow-through share donation arrangement signals to the ever-growing investment community incorporating ESG factors into investment decisions that the issuer is enabling greater charitable giving in local communities and beyond, as well as demonstrating responsible stewardship of investors' capital. As mentioned earlier, since flow-through funds must be used on prescribed categories of exploration and development expenditures within statutory time limits in order for a subscriber to be able to deduct the subscription amount for the flow-through shares against their own income for tax purposes, the proceeds raised in a financing go into the ground so investors can see projects progress on time and on budget. Thank you so much for tuning into this presentation, and I look forward to answering any questions you might have.